ICE steps up with a $2 billion investment into Poly Market. Like this, none of these things would have been happening even as recently as a year or 2 years ago. Fifth Third steps up and takes out Comerica. There's a lot of aggressive activity happening in the financials that has absolutely nothing to do with how many GPUs are being bought.
Why have many of the names within the group, the largest ones, over the past 30 days, not done all that much?
Because look what they did in the first half of the year. These are all still in statistical uptrends, but stocks that have gone up a lot. Here, there's your chart.
But you're saying that earnings are going to start the next leg for this group?
If we see anything even close for the money center banks to 9% earnings growth, who's selling?
Well, I'll just come out and say yes.
Well, Goldman
yes.
says you're to buy Citi calls ahead of earnings. So if you want to do something ahead, buy calls. Citi's on track to meet medium-term targets driven by solid fee growth, efficiency improvements, and strategic divestments. The option implied moves capturing earnings are attractive versus its average 8-quarter earnings day move.
Look, Citi has a very specific set of circumstances to it, not necessarily applying to Bank of America or Goldman Sachs, but they're about to do the Banamex transaction sometime in the next 3 to 4 months, spin that out. And after that happens, I see absolutely no reason why this should trade at a discount to tangible book value. It's just below that right now. I mean, you look at something like Bank of America at 1.9 times tangible book value, and I say rhetorically, why shouldn't Citigroup be there? And if that were to happen, that would be almost a double from here. Now, it's a little bit provocative. We'll talk again when we're at 120% of tangible book value, which would be around 120, 125.
Well, I mean, it was provocative way back, pull the chart way back when you first got into it.
That was like 50%.
Made the case for Citi in the face of what appeared to be a lot of headwinds and what appeared to be an extremely heavy lift by Jane Fraser. I mean, she's lifted.
She's done a good job.
Lifted.
She's done a really good job. She hasn't gotten full credit for it yet.
I mean, come on, look at the stock. What do you mean she hasn't gotten full credit for it?
Okay, because it trades at less than, good question, because it trades at less than 10 times earnings. As I said, just a hair under tangible book value. And you got Bank of America, fine bank, trading at almost twice the multiple of tangible book value and about 40% higher multiple of earnings. So I think there is a lot more opportunity left to come in Citigroup.
Sector-wide, the beat rate for financials 80% this year. Okay,
How do you get bearish here?
Well, that's my point. Is like so taking Q4 numbers, which were reported to us in January, right, and taking Q1, Q2. Now we're going to have Q3 reports. 80% beat rate in this space, and tons of upside to guidance each time they've reported. Even during the spring, these stocks held up pretty well, considering how scared most of the market was about the impact of tariffs. I think they deserve the benefit of the doubt. The one that I'm in, JPM, one of the best performing stocks in my portfolio, probably in the whole S&P 500, depending on the time frame. This stock has just been explosive during the last 2 years of this bull market. This is a company that's still looking to post $4.83, which is a 10% year-over-year, or 10.5% earnings growth, 5 and change percent revenue growth. It's a 14.5 forward multiple with, and it's a company with 20% net profit margins. Like, who's hitting the sell button if they do the number? I can't even imagine why you would.
All these names all hit record highs within the last 3 weeks. Now,
all right, you got it.
If you're looking at them, they typically spike. If they get good earnings, you're going to get a spike. They typically come back in a day or two following that, but the earnings story will tell you what to look for and then to buy that pullback.
It's always good to hear from Jamie Dimon, of course, which you will, and we are, because we did yesterday. He was asked during an interview what he thinks about the current market landscape, as many are weighing in on whether there's a bubble in AI and maybe some other places too. I want you to listen to what he had to say. You're not going to see Jamie, but you're going to hear his voice. Listen, we'll talk on the other side.
It's really impossible to tell the burst. And I've looked at, you look at history when all, the 74 crash, the 82 crash, the 87 market, the 90, the internet one that you mentioned. No one's really forecasting that. And there's all that hype out there. And then you also take AI, there's a lot of money going into it. But the better way, I look at the better way, AI is real. AI in total will pay off. Just like cars in total paid off, TV in total paid off, but most people involved in it didn't do well.
Okay, so that's Jamie on whether he thinks there's a big bubble in this market. It doesn't really sound like he's all that worried about it now. AI is real. AI in total will pay off. Goldman agrees we're not in a bubble yet. Valuations look increasingly stretched, they say, but not yet at the levels that were typically in other bubble periods before they burst. The biggest risk is that earnings disappoint and investors start to question the sustainability of their current rates of return. I mean, I think that's a little obvious, right? I mean, we talk about that, Shen, kind of every day. That's the greatest risk, but I don't think anybody's that worried about that risk coming home to roost in the near term.
Well, I think that also helps that it's an understanding that some of the transmission of the AI capex that's been done is going to take some time to actually be monetized by these companies, not necessarily just at the front end. I mean, I think some of the challenges, Scott, right now are questions about the, this wave of vendor financing that we're seeing and the potential for that to create kind of a bubble precedent, if you will. But at the end of the day, the reality is that you're going to have a little bit of time in terms of determining what the return is for these investments. And what's going to happen coincident to that is you're actually going to start to see companies in areas like financials, in areas like industrials, to Josh's point earlier, they're going to start to be able to show real use cases for AI within their businesses. And that's only going to create a longer tail for these AI enablers, because there's going to be these clear use cases that are outside of just financing each other.
How about this? The tech sector, right, as a group, the forward PE today is 31.1 times. Okay, when people talk about, well, it's a one-trick pony in this market, and it's tech carrying a large portion of the load, not all, of course. The forward PE 20-year average for tech is 17.9. So you're at 31 versus 18. Let's call it that, over a 20-year historical period. Average, what do you think?
Well, I think it is a little high, but here's the thing. You're paying for that growth, and you're paying for the story. But you could pick names within there. Amazon, lowest valuation ever. AWS growth is still just lights out. Google or Alphabet, it's a kind of a call on quantum computing. You get a forward 21 on there. It's growing 20 to 30% a clip. And Micron is a name that I've talked about a lot on the show. There's a lot of arguments there that it's still undervalued. So there's some places to pick out here within the AI space that there's an actual value. But again, as you cited, it is a very big deal that these earnings come in and they beat expectations and raise. This is not going to be like the April and May earnings reports where that bar was set so low, or I'm sorry, the following the April and May.
When I read a stat to you that says AMD is up 43% in 3 days. In 3 days. You sold the stock before.
It's a repricing, yeah.
Does that sound like it's okay?
It sounds a little.
I'm not saying it's not. I don't mean to ask it in a way that suggests it's not. But 43% in 3 days. It's
absolute repricing, and there was zero flows, zero interest in it. It was almost, in some argument, left for dead. The technical picture was ugly, but if you back it out a month, then you look at a name like Micron, up 40-50% over the last month. AMD is up about the same amount over the last month. Like a Lam Research, you go into the equipment names. A lot of those names are up 40 to 50% over the last month. AMD was, before that moment, was up zero.
Can we put the 1 year chart of AMD up? Nope. A little bit. Back it up a little bit.
They will.
So I think it's an important point that you raised. Who buys charts like this? Who's the buyer today? I can't even imagine who that, like the last Muppet that must own this stock no matter what. I can't even imagine what the thought process is. It looks incredible, obviously, but does nobody think that there's the potential for 2 or 3 bad days in the market? Half of that 43% to be wiped away?
Retest 220, 215. What was that? The March high from early last year.
Yeah, no, I think it's a valid point. You have multi-$100 billion market cap companies going up 40 and 50% inside of a week.
Yeah.
It's ludicrous activity. It doesn't mean AMD doesn't deserve to be there. It's the speed at which these things are happening, which is why I said at the top of the show, I don't know that we're going to have a news air pocket. Every day I wake up, there's some massive deal between Oracle or NVIDIA or OpenAI or AMD or all 4 at once. It's really hard to look at this market environment and say, yeah, there's going to be a little bit of a news ebb. I just don't see it.